Have you ever wondered why a grand blueprint for global economic realignment, this really aggressive strategy aimed at cornering a major economy, is already running into these critical failure points? I mean, just look at a place like Mexico.
Exactly. And maybe the more unsettling question is, what if the biggest vulnerabilities aren't even abroad? What if they're hidden in plain sight right here in the U.S. economy, masked by missing data and, frankly, some unprecedented funding pressures in tech?
Right, that gap between the ambition and the reality. That's what we need to unpack.
That's the mission today.
Hmm.
We're going to connect the dots between the U.S.-China trade tensions, the collapse of some of these strategic goals, and the instability we're now seeing in tech and even in our own employment numbers. You can get a really clear picture of why a very shaky truce is the best way to describe the global economy right now.
And we're going to show you the numbers behind it. We'll look at trade deficits, the trillions needed for AI, and really understand what it all reveals about the fragility of this whole strategy.
So let's start with the plan itself. It's often called Fortress America, and it's much more ambitious than just tariffs.
It's about aggressively reshaping global trade, and it requires this massive coordination.
It does. The core idea, which is kind of chilling when you think about it, is to use key U.S. allies as a de facto sovereign wealth fund.
The sovereign wealth fund for U.S. reindustrialization. So it's not just about stopping imports, it's about shifting the burden of rebuilding onto partners.
And the scale is just fascinating. Allies are expected to liquidate huge offshore surpluses and reinvest that capital back to new factories, new infrastructure, all within the U.S.
So we're talking about real money, real factories.
Huge money. Take Japan, for instance. The figure being floated is around $550 billion, just from Japan alone, repurposed for American manufacturing growth.
So this isn't passive investment. This is an active strategic move of capital to build capacity on U.S. soil. But surely that destabilizes their own economies, forcing an ally to move $500 billion.
It creates significant pressure. When a country like Japan repatriates that kind of sum, it puts immediate strain on its currency, the yen, and it starves its own domestic projects of capital. The goal is American reindustrialization, but the trade-off is slowing down manufacturing everywhere else in the bloc.
And beyond just bankrolling the rebuild, there's a defensive part, right? This joint shield.
The joint shield, yes. Allies are expected to form a cohesive line, a wall, to push back against the, quote, flood of Chinese imports.
And that's crucial because the U.S. can't do it alone.
Not at all. Despite the tariffs, China's overall trade hasn't collapsed. Beijing just pivoted. They're selling huge amounts to Asia, Africa, the Middle East, Europe. So the U.S. can't really impose global sanctions without crippling the world economy. The strategy relies entirely on allies forming this economic cordon.
And that ambition extends to our own hemisphere, too, right? The Argentina bailout for $40 billion that felt like more than just saving an economy.
It was a clear geopolitical move. It was about cementing U.S. influence, hammering in the idea that this hemisphere needs to stay aligned with the Fortress America plan.
Which brings us directly to the single biggest weak point in the whole strategy.
In Mexico.
Mexico. The control of the USMCA trade agreement, the border, that was central to the entire fortress, and it seems to be collapsing.
It is. And you can see it plain as day in the trade data. Over the last 6 years, U.S. imports coming directly from China, they've collapsed by over 33%.
Which, on the surface, looks like a policy win.
It looks like a huge success, but here's the twist. During that exact same period, U.S. imports from Mexico, they grew by 20% in real terms.
Okay.
And now for the aha moment. You look at the third side of this triangle. In that same period, Mexico's imports from China also shot up by almost 20%.
Wow, that correlation is undeniable. So Chinese parts, components for electronics, for cars, they're just coming into Mexico.
Getting assembled or finished.
And then shipped duty-free straight into the U.S. under the USMCA. The trade war is just being routed through a third party.
That's the loophole. And now the U.S. is pushing Mexico really aggressively to slap massive tariffs on Chinese imports to close it. But it's hitting what's being called stiff resistance from business leaders, from lawmakers, and it's been delayed until at least December.
But wait, if we force Mexico to close this, doesn't that just mean higher costs for everyone? I mean, U.S. consumers will ultimately pay the price.
That is precisely the problem. It's a massive catch-22 for Mexico. They rely on China for industrial inputs, machinery, components, raw materials, and the tariffs being proposed they're punitive. Up to 50% on car parts, 35% on electronics and steel. We're talking across almost 1,400 different product types.
50%. That sounds like asking Mexico to commit economic self-sabotage just to help U.S. strategy.
It is. The cost calculation for them is devastating. Chinese parts often provide a cost saving of over 25%.
Okay.
So if Mexico complies, their input costs just explode overnight. And even if the U.S. then drops its own tariffs on Mexican goods to zero, it doesn't matter.
Why not?
Because the higher production costs destroy Mexico's export competitiveness globally. They might get better access to the U.S., but they forfeit the ability to sell competitively to anyone else in the world.
So this is about controlling the entire manufacturing supply chain, not just finished goods. And if Mexico complies, I assume investment just dries up.
It halts. Immediately, Chinese foreign direct investment would stop. Those factories would just shift their operations to, say, Brazil or Peru, taking high-value jobs with them. And you have to understand the scale here. Mexico's trade deficit with China is nearly $120 billion.
$120 billion.
That is more than the next 13 countries combined. Tariffs on that massive flow of goods would translate immediately into domestic consumer price inflation, hitting everyday Mexican citizens right in the wallet.
That is an impossible position to be in. Okay, let's pivot from that. Let's talk about stability here at home. Because at the same time all this is happening, the U.S. economy is showing some major red flags, starting with the very data we rely on.
This is a really concerning development. What happens when the center of global capital markets just starts omitting critical economic data? The big red flag was when the U.S. skipped conducting the household survey back in October.
Okay, skipping the household survey, can you just break down how serious that is? Why is that one piece of data so important?
Because it means we only got half the employment picture. The full report has two parts. We got the payroll part, how many jobs businesses created. But the household survey is the only thing that measures the official unemployment rate. They actually call people. Without it, the Federal Reserve is missing the most critical number in its equation.
So it's the difference between knowing how many jobs were added and knowing how many people are actually looking for work but can't find it. That's fundamental.
It is the absolute cornerstone metric for the Fed's interest rate policy. It's what companies use for their own hiring and firing decisions. Taking away the official unemployment rate creates this huge void, especially when you pair it with other things like the cost of that government shutdown earlier this year.
Right, the shutdown gave us a taste of this instability. It led to 60,000 private sector job losses and cost the economy something like $15 billion a week.
So you connect all that,
Correct.
and it creates this impossible situation for monetary policy. The Fed is supposed to be data dependent, but they're operating without one of their most crucial metrics. The uncertainty is so high that right now the market is split 50-50 on whether there will be a rate cut in December.
So without the unemployment rate, the Fed is essentially forced to, spin the roulette wheel.
That's a perfect way to put it. If they raise rates too high in this environment, they risk a systemic implosion, a rapid, uncontrolled recession. But if they keep them too low, they could trigger a massive inflation shock. This kind of opaque data makes sound policy incredibly difficult.
All right, let's shift to the tech sector. Because despite all the talk of U.S. dominance, we saw the NASDAQ lose over $220 billion in market cap in just one day recently. The sector seems wobbly, and it begs the question, where is all the money going to come from for this AI future we're promised?
This is the massive funding challenge under the surface of the whole AI race.
Yeah.
The estimates for building out the necessary global infrastructure, data centers, cooling systems, power supplies, run from $5 trillion to over $7 trillion.
$5 to $7 trillion. For perspective, the entire New Deal costs less than $1 trillion in today's money.
It's a staggering amount of capital.
Yeah.
And the investors funding this expect astronomical returns to justify the risk.
Of course.
And that's the key. If U.S. tech can't maintain really high growth, say 20% a year, that capital will flee. Why risk it when you can get a safe 3 or 4% from bonds? To maintain even a 10% annual return on those AI investments over 5 years, the sector needs $650 billion in new capital annually.
$650 billion a year? To make that real, that's like demanding an extra $35 a month from every single iPhone user on the planet, or $180 a month from every Netflix subscriber, just to keep the investors happy.
Exactly. And this money isn't just for shiny new chips, it's for boring stuff. It's for buying land and building power plants. Every major data center needs the power of a small city. That means upgrading the physical energy grid, which has a much slower return on investment than software. The scale is so big, it's very likely the U.S. government will have to step in with subsidies.
So the trade friction, the protectionism, it might just continue because it creates a powerful domestic argument for redirecting public money to prop up this capital requirement for tech.
You can see the logic. If the market falters, liquidity will be needed. In a worst-case scenario, you could even see the Fed buying U.S. bonds just to inject cash, allowing companies to borrow more for AI subsidies.
And yet, even with all that potential government backing, China has a very powerful, very unique edge in this energy-hungry AI race.
It's fascinating because this whole competition might just hinge on who has affordable, scalable energy. And in that space, China completely dominates. They manufacture 80% of the world's solar panels and 60% of its wind turbines. And crucially, they're securing huge amounts of Russian oil and gas at fantastic discounts.
So while the U.S. has to spend trillions just to build out its energy grid to meet this new AI demand, China's starting cost is much, much lower.
Correct. For China, the incremental cost of power to scale its AI infrastructure is near zero. They control the energy supply chain, so they can scale up faster and cheaper. Even if they're using slightly less powerful chips, their ability to scale efficiently could be a huge long-term challenge for the U.S.
So if you're trying to make sense of the global economic climate right now, what does this all mean? We have this Fortress America strategy facing huge vulnerabilities. There's a trade plan that hinges on Mexico's compliance, which may never happen. We have domestic economic data that's suddenly opaque. And an AI race that needs capital and power that the U.S. doesn't fully have yet.
And that brings us to the final thought we want to leave you with. If this Fortress America strategy does fail to secure Mexico, and Chinese investment simply shifts to places like Brazil or Peru, effectively outflanking the U.S. trade perimeter, then you have to ask, what is the ultimate long-term cost of using protectionism as your main geopolitical tool? And if this strategy collapses, how many years will it take the U.S. to find another viable pivot point?